I really appreciate you making the time to come to the podcast and share a little bit about this world of venture studios.
Absolutely.
You are the founder of the largest community of venture studio community in the world. And I have some numbers here, which are quite interesting. There's over 1,250 members that you have today in the group.
Mhm.
Created 48 billion in enterprise value.
Yeah.
Of those, 11 were unicorns. That's the latest data I have.
And that data is based on work that I did, and it's a little dated. So we haven't done a full survey because
Okay, all right.
we had, I think it was somewhere around 700 or 800 members. So now
So,
that
well,
we're well over 1,200 members, those numbers obviously will have grown potentially substantially. So yeah, it's been great to see the growth of the community and really get to know some of the studios that have gone on board and gotten involved.
that's phenomenal. So this is without a doubt the largest venture studio organization in the world today.
Yes.
So congratulations on that. I would love to
Thank you.
hear a little bit about what got you into this world.
So the first startup that I did, I got some advice from a local venture studio. They didn't know they were a studio at the time, but that advice helped me get into an accelerator out in the Bay Area. I was doing a metal 3D printer startup and sat down with the studio. They looked at the deck and gave me some pointers. And, hey, you need to kind of position it this way, think about it this way. And they were one of the pillars of the local startup ecosystem, and they still are to this day. And uh, they're actually really, really good friends. Like they play board games like once a month with the founders of High Alpha, one of the more prominent and larger venture studios in the US. And so their early studio design really inspired the folks that came together that started High Alpha. So that was kind of my first exposure to the model. I looked at joining several different studios, working with several different studios over the next few years, and went through the GSSN boot camp on venture studios. And the facilitator there, Alper Selen from Enhanced Ventures in Dubai, said, "Hey, everybody should be active on LinkedIn. That's a great place to meet investors, meet entrepreneurs, like build that network." And so I got active there. One of my posts went viral a few months in and got 1.5 million views. And everybody started pinging me on the DM saying, "Hey, you know how this venture studio thing works. Can you help us?" And so I got pulled in sort of accidentally into
Forced into this,
yeah,
yes.
I was like, wait, I had like 100 DMs literally asking me like, "Hey, can you help me in my studio?" I'm like, I think the right answer here is yes, and then I'll figure the rest out later. Like, what do you mean by help?
Yeah.
Let's hop on a call. Let's figure this out. Can I help you? Can I not? And that really grew into consulting in the space. Helped me define a lot of the kind of design principles. I got to look at now well over 500 venture studios all over the world. So I got to see so many different designs and ways to approach building companies, and that really gave me, I think, a very unique perspective to one, create a lot of these design frameworks. But I used a lot of that in developing the standards that we've published for venture studios. Because if you take a design standard and you kind of flip it on its head, it's a due diligence standard, which is effectively what a standard is. Like, do you meet the standard? This is what we expect to see in something that behaves like a studio. Are you there?
So up until now, there was no standard really, and
Nothing
you came
official.
up with a nothing official.
Mhm.
So I think there's a lot of misconceptions about what a venture studio really is and what is really a venture studio, because there are many things out there that they call themselves venture studio, but they're not really that. So how would you define what a venture studio is then?
Yeah, we would define a venture studio as a company that builds other companies, having meaningful control, playing three core roles. Every studio has to play an entrepreneurial role, an operator role, and an investor role. And that's really critical. And by control, we mean the studio doesn't have to have full decision control over everything that happens, but they have a seat at the table. They're a co-founder, right? And so if you imagine a normal startup, If somebody is there as a co-founder, they get to strongly influence and help shape the decisions that get made. So does a studio. And so you can apply that standard and look at an accelerator or an incubator and go, okay, an accelerator provides some financial investment. They have some protection provisions in place. So they have some decision authority around the investor role, but they really advise on the entrepreneurial and operator role. So they don't have control there. So they don't rise to the level of a studio. When we look at an incubator, they rarely make a capital investment. They're really just there to facilitate and really help companies make the right connections and give them a space to develop. So more advisory, no control. And even a venture fund is really just playing that investor role, not moving into that operator and entrepreneurial role in the vast majority of cases.
This looks extremely complex. So you're playing
Yes.
you're playing three roles. So this entity, the venture studio, will be essentially one co-founder for new businesses, startups.
Yes. Uh,
So yeah, go ahead. Yeah.
well, yeah, I love the co-founder framing because if you would
Yeah.
imagine the ideal co-founder is somebody that can show up, has some playbooks, can bring a team, has expert connections in the industry, access to capital, and can bring the initial capital used to build a company. That's like the ideal co-founder to show up. And that's what a venture studio should do is show up with all those things in place to really accelerate the creation and build of companies.
Why is this a thing? Why venture studios? And there's a lot to be said in relation to how it outperforms VC funds. But what can you tell?
Sure.
Yeah,
I think it's a couple of different threads coming together. If you go way back in the early when venture capital was still an emerging asset class, those early venture capitalists tended to behave like single person studios. They would go in, get a lot more involved in the companies that they're investing in and help them grow, help them operate. We don't see that as much today because we've started to more formalize this asset class and it's moved from more hands on to more just financial investment and management. So, one version of a studio is like looking back to how the old venture capitalists did things and say, hey, how do we reimagine that operation and make it a little bit more sophisticated today? What I see when I was working with a lot of exited founders is that they would look back at the early couple of years when they were building their company and realize like that was one the funnest time, but it was also the hardest. And they start imagining what the best support would be. And then invariably that ends up as some version of a studio, right? I want somebody there that can do my hiring for me or can like streamline the hiring process. They can do early sales. They can like support me in all these areas, and that organization starts to look like a studio. So I think this is a very organic uh, and kind of collective answer that people will end up going to as they look to really streamline and improve how you build a company from scratch because it's a really, really difficult endeavor.
it is. And as we were talking about, it's really complex because you're playing three roles. I mean, that's what makes you a venture studio. You have to an entrepreneur, get in with the operations, and as an investor. So three.
Yeah,
So those three roles in one single organization. My question is, when you compare these to, well, private equity, they buy the majority of the company, they transform and they might have, probably bigger private equity companies, they may have their services they provide to their portfolio companies. You have some of those. VCs, mostly they invest, they might help with some sort of ecosystem or community, things like that. But when you think about venture studios, how does it look in terms of how the equity structures look? Because if you're there as a co-founder, not only as a capital partner, I mean,
for
it's
sure. No,
uh,
they're obviously going to
yeah,
play a little bit larger role on the cap table. The challenge here is there's a big range that they can play in. I've seen studios take as little as 10% and sometimes more than 90%. And all of those can work. So there is no one answer. The best answer really is understand what you're building, who your end customer is, what that liquidity pathway is. If I'm a studio building for venture capital, the next customer of the companies that I'm building is going to be a venture capital investor. They have to be able to say yes to that investment, or I, as a studio, have completely failed. So that is going to really shape what an acceptable cap table looks like. If I'm a studio building for a private equity exit, well,
Okay.
now this looks completely different because I might, as a studio, get fully bought out, and the entire team in the portfolio company might get fully bought out. Or to go even further, if I am looking at debt as that follow-on capital source, not an equity investment, now the cap table doesn't matter as much as a barrier to continue to secure additional capital to grow. So there's a lot of variance, and it really goes down to how you decide to play the game of building companies. What's your strategy? What's your thesis around what you're building?
Right. So you look at, because when you think of the end customer, you're talking about VCs or private equity. So the product you're selling is the business, right? As a venture studio, your product is a
Yeah,
business. The
absolutely.
customer is whoever buys you then. Are there, yeah, go ahead.
Yeah, yeah. We built a financial framework around this because venture studio legal structures tend to get a little complex. And it really boils down at the end of the day to how the studio is going to use the capital it gets to create and invest in companies. And so going back to what you just said, if you say the business of a studio is to build companies, the company is the product that the studio is building. So, what's the cost to build your product? Cost to build your portfolio companies? What's
Yeah.
your overhead to run the studio? And then, how are you structuring your investments? What's the formation capital to start those companies? What's your direct investment? And what's your follow on strategy? That's really where you're going to be deploying capital inside a studio framework. And it really does align with you're building companies, that's your product. So whatever that follow-on capital source is going to be is one of the customers you are building for.
Right. So you have multiple customers, multiple players as well.
You
I mean,
definitely
who,
do.
why would someone want to get into the venture studio?
I think there's a couple reasons. The
Yeah.
the entrepreneurs I see go in and start studios, that portion of company building for them is the funnest part of the process. It's going from unknown, like I don't know what we're actually going to build yet. We're going to go figure it out. To here's the company, here's the product, here's the customer. It's working. Let's move it on its way and let it continue to grow. Let's go do the next one. So if you love that 0 to 1, the studio is an ideal place for you.
So venture studios, you should start the company from scratch to be a venture studio,
You do not
essentially.
have to. No. So what I've seen in talking to studios all over the world is there's really four different, I'd say, founder roles that a studio can play. Studio can be the founder. So they find the idea, they validate it, they start building it out and pull in either a CEO or a founder to continue to lead that business. The studio can be the co-founder. So you're going to partner at or around the idea stage and you're going to build together. You can be the late co-founder. So the studio is joining an existing business as a co-founder. And then they build the business together. So an example of this, because this is a little bit of a different one than most people are used to, Science out in LA joined up with Liquid Death. Liquid Death was
Yeah.
applying to accelerators at the time, so they were already kind of formed. They had a product idea, they had some traction, they could get into accelerators. Instead, they joined up with Science. And there's one more form of founder role that a studio can play. It's kind of unique to a studio, and I call that the refounder role. This is where you're
Oh,
starting with something. Generally, this is IP. So I'm licensing some technology from a university or from a corporation, or I'm acquiring an asset to build from. This could be a company that I'm turning around or a company that I'm using as a starting place to build from. So it's a different kind of operational motion that you're going through, different skill set you need to do each one of those founder roles effectively. But yeah, you don't have to start everything yourself. But no matter what, you're going to be playing an entrepreneurial and founder role as you really shift the direction and build this company.
Right. You're talking about Liquid Death. That's the water,
Yes.
cool water company.
Yeah. Science has got a couple of good successes in the consumer product space. Their first one was Dollar Shave Club.
Yeah, yeah, yeah,
Very
yeah.
good on the marketing and branding front, and of course that aligned very, very well with
So
death.
what's they're great at? Okay,
Yes,
okay. So you have these four different roles, and you thinking about who you're building for. I mean, venture capital, private equity, whatever. Have you seen any venture studios that build only for cash flow? I
oh
mean, I
yeah,
want to have cash flowing businesses.
for sure. It's actually one of my favorite models for a couple of reasons. One is that you can apply that almost anywhere. You're not really dependent on the broader investment ecosystem because you don't need follow-on capital. So in almost any economic region, I can apply this model, and I can start generating returns very quickly. So a very specific example: a couple of my partners at the 9.8 Collective are GPs in this particular studio. They started it about 15 months ago. I believe it's 1.5 million in. It might be less than that. They're about to make their first distributions to LPs. They're on track for a 45% IRR. And the whole goal was to build cash flow companies, be cash flow neutral by month 18, and have 2 million in EBITDA by year 3. They've obviously outperformed that goal, but it's, that studio is not the first cash flow studio I've seen, and the model can work really, really well. And that's one of the stories I like to share because it really kind of shows the scope of where studios can play. I can build venture funded stuff, I can build biotech stuff, I can just build boring old cash flow businesses. And at its heart, a studio is just about building companies that work. There was no restriction placed on what kind of company it is. And so that gives you a lot of flexibility in how you choose to apply the model.
This is great. I mean, that can be applied to so many different spaces.
It can.
One question I wanted to ask, you think about the venture studio, all the roles that a venture studio plays. What have you noticed are the skills required, or what does the perfect team to build that venture studio looks like? Is it a former entrepreneur? Is someone that knows how to raise money? And what
Sure.
does it look like the perfect team, in your opinion, right?
So it'll vary a little bit based on the studio strategy. So if
Okay.
follow-on capital is going to be a critical element for the companies that you're building, then having the ability and that network to tap into to secure that capital becomes a really critical factor. Almost universally, one of the really big factors for long-term success of a studio is recruiting great entrepreneur and founder talent. So if you don't have that network, and let's be honest, a network will only go so far in this. At a certain point, you're going to tap out that network and you're going to run dry. So you're going to have to build a process to recruit great founder talent. So that often will come down to the marketing and branding of the studio or the founders specifically involved in that studio. And do they have a personal brand that will attract great talent or not? Then, of course, you still have to build companies. So you have to have great skill sets and experience around what that really, really takes. So yeah, you can get a lot more specific based on, the specific studio you're building.
What
Like
you're
if you're
building, yeah.
building biotech, you probably better have some biotech talent. But I often use those three roles as a really good lens to evaluate the founding team of a studio: entrepreneur, operator, and investor. What skill sets, what superpowers is that team bringing to bear in each of those roles? Are there any gaps? And generally, you're going to find a gap, especially in a younger studio. So it's not necessarily a deal breaker, but you have to understand how they're going to overcome that gap. And is that gap really going to be critical early on? And I'll highlight one gap that often is critical if you're building into venture capital and you don't have a network into venture capital. It's really hard to build that network while you're building all your portfolio companies.
You make a distinction between entrepreneur role and operator role. What would be the entrepreneur role?
Sure. The entrepreneur role is really figuring out what that opportunity is, shaping it. It's at really, really early 0 to 1. I got an idea, but no idea
Yeah.
survives contact with reality. So, how do I take this an early idea, the seed of something, and really figure out what is backable? The operator role is much more, I know what we need to go do to make this successful. So here's what sales looks like. Here's what managing great software development teams looks like. Let's go, operate and build out the process, the structure on how we build this portfolio company, this technology, and build it in a way that we can scale it in the future.
I mean, when you have all this infrastructure to build this company, they they say that it's a way to de-risk the company creation, and probably that's why this is gaining relevance compared to venture capital, right? How is this model de-risking investments?
So one way to look at how the process of a studio really plays out is I know that I'm building for an end goal when I'm starting a studio. So maybe I'm building to take things public. Maybe I'm building for venture capital. Maybe I'm building for private equity. When I know what that target is, I understand what the standards and expectations are that I have to deliver to. Now, can I take those back to the very beginning and start layering in those expectations as early in the process as I can? Like we see venture do this all the time anyway. So there's no big surprise here. It's just a little bit more sophistication. Venture will often say, hey, if this is not a multi-billion-dollar market potential, like it's not big enough. All right, that's a really easy filter to apply at the idea stage. Like this is not something that is
Yeah.
big enough. We need to evolve it. It's not ready to continue on. That's a really simple example, but I'll give you a really, really specific one too. Really interesting studio called MDB Capital. They
Mhm.
license IP, they build a team around it, they raise one private round, and then they take the company public themselves. So their skill set when they created this studio was they knew how to take companies public. They knew what the public markets needed to see. And so they built that into their process. They don't license technology unless they're confident it can perform well on the public markets. And they've been around, I think, 28 years now. They've done this 17 times, licensed technology 17 times, built 17 companies, 17 IPOs. Five of them have become unicorns. That's a 30% unicorn success rate.
Wait, you say 17 companies, 17 IPOs?
17 IPOs. Every time they
Wow.
built a company, they IPO'd it.
Wow.
So
Wow.
that's a real good indication. Like they knew what would perform well on public markets, and they didn't say yes unless they knew it could perform. And so, that's a really good example of great strategy built into that process of a studio. Like we're not going to say yes to going to build something unless we know that when it goes out there, it's going to attract the capital that it needs.
So you're starting with the end in mind. The end in
Very
mind
much
is your customer, call it VC, call it PE, call it IPO, call it cash flow, call it whatever. But based on what you're telling me is looks like you really need to have clearly defined before you launch anything who you're building for, or what you're building for.
It definitely helps because if you're trying to make it up as you go, what standards are you really using to evaluate what you're building?
Right. Right.
Yeah,
It makes everything even more complicated.
it does. And there are definitely
Right.
studios that do that, right? But they've got a real depth of talent and a skill set around that. So it makes it harder. Like the more focused you can get, the easier it is to hit that target consistently.
Yeah. Talking a little bit about the type of founders, right? Talent you need to attract. Do you see, and this is something that I've been noticing, from talking to several different executives in private conversations, right? I noticed that many of them, when they get to a certain point, they are the C levels, 50 years old, 55 years old. They say probably, I don't know if I want to keep doing this, right? But they have the network, they have the brand, they know how to operate a business. Probably they've never been entrepreneurs, but have you noticed, talking to different venture studios, this type of founder entrepreneurial profile, the senior executive that has built a great career and now he wants to try something different?
Yes. And I'll give two examples. So there was a studio in Atlanta. They shut down about 20 years ago. They were focused on cash flow companies. They were very successful. The guy behind it is an angel investor. He's backed a couple of different unicorns. His biggest investing regret is he stopped doing this. Just to level set it here, he would partner with VPs of IT departments to pull them out to start their own consulting business. Very successful at it. There's also a studio called Juxtapose in New York. They spend 1 to 2 years doing due diligence, figuring out this opportunity, building out the playbook, the product roadmap, finding the first like 500 customers. The founder that they look to recruit isn't a founder. It's a 3-time public company executive that they come in, they want to bring in and say, hey, you know the industry, you know how to lead teams, you know how to run playbooks and processes. Here's the opportunity, here's the playbook, here's everything. It's full business plan. Go build it.
What an opportunity,
Their
man. This,
success rate is crazy. They have, I think it's a 100% Series B success rate.
wow.
Yeah. It's a
So
different way to play the game. Completely different.
it's,
That works.
I mean, I don't like to you're short, but you're shortcutting and de-risking the entire thing because it's the founder there. I mean, it's the executive. They built a network. They're well known in the space. They got to where they are. They're not. They're not stupid, uh, and they know how to operate a large business.
They just, in Juxtapose's case, if you take a 3-time public company executive, they probably have never done that 0 to 1 stage themselves. So the studio takes that on, builds it all out, de-risks all of it. So like, here's the play to go make. And now suddenly an executive can come in and run this and they're in their comfort zone. They're playing to their strengths. And this is kind of that ideal pairing. When you look at a studio and the entrepreneur they're going to work with, how are they supporting each other? Are they really filling each other's gaps, or are they, creating a couple of really big ones? It's always a good area to look at. And done well, it really pairs well and it just really amplifies success.
And especially if they're motivated, they want to do something different. And
That's
I
right.
mean, wow, that's phenomenal. That's a great
I
example.
mean, if you look at most public company executives, they're never going to get more than 1% ownership in the company they're working at.
No,
So
absolutely.
when a studio shows up and it looks more like a private equity studio, because hey, we've put millions in, here's the full playbook, we're going to put more, several more million in to fund it. Hey, you're not looking at 1%, you're probably looking closer to 10, 15%, maybe more as that executive. That's really interesting. That's a private equity level ownership with a lot more growth potential.
That's great. And also, I mean, sometimes even they have the idea, they have all the insights into the industry and the
Yeah.
problems and things that, if you're not there, you just honestly don't know.
Mhm.
The other day we were talking about innovation inside corporations. So when you think about how venture studios could play a role for innovation inside large companies, and that collaboration, what have you noticed? What do you see? How does it work? What insights can you
Oh,
share?
this is a huge area to unpack. So I'll
Yeah.
start with a couple of really interesting data points. I
Okay.
think there was a study maybe a little bit over a year ago. It was, I think, third or fourth quarter 2024 that McKinsey put out.
Mhm.
I think it was about 50% of the CEOs surveyed put venture building in the top 3 strategic priorities. which came as a shock
50%.
because it wasn't on any survey before. It like didn't crack the top three,
Yeah.
and then suddenly it's like 50%.
Wow.
Whoa, like what's going on here? And the let's see, global venture building report survey came out just about a month ago, maybe less, and they had some really interesting data where about 1/3 of the companies that had corporate venture arms also have venture building efforts or venture studios. So this is a rapidly growing trend in corporate innovation, in corporate development. So it was actually pretty stunning. Something like 2/3 of corporate studios have started in the last 6 years. So it's very young and
2/3 in the last 6 years.
yes,
Wow.
these efforts are very nascent. They're just getting started. The best practices are still really being established. But I think there's a few things we can kind of pull out as we look at it that point to a better direction on how to implement a studio inside of a corporate context. Like I've spent several years in corporate innovation, so I know some of these struggles firsthand from a internal corporate innovation perspective. And there's a few things I look at as far as optimizing a venture studio in a corporate context. As difficult as it is, make it a separate legal entity. And the reason is governance. You really need separation for a couple of reasons. One, you can, as a corporate, you can still fully control the studio, so you can keep that control. But if the studio that needs to move fast, build very quickly, and be nimble has to rely on the internal departments to support it, you've got a really big conflict built in because all
Yeah.
those departments, they've got their day-to-day that they have to deliver on, and they got VPs over them that are pushing them in directions and pushing them on priorities that they still have to meet. The studio doesn't register in any of that. So it
Quick,
becomes
quick
a
question.
shocker to move fast. Mhm.
So it should be created as a totally separate entity, controlled by the corporation,
Yes.
but operating full independently.
Operate it and independently, allow that studio to have its own team, right? The team
Yeah.
that can, go call customers, go build stuff, that doesn't have to rely on going back and, for example, saying, hey, corporate legal
Ask for approvals.
department,
Yeah.
can you review this legal contract? They're like, yeah, it's not high priority. It's in the queue. We'll get to it in like 3 or 4 weeks.
Yeah. Yeah.
Okay,
Yeah.
that's a 3 or 4 week delay, right? If you have to rely on corporate market research, now you're like, okay, where are we in the queue? All right, eventually we'll get there. Like that slows a lot of that work down. So you need to have the studio operate a little independently from the rest of the organization. The best way to do that is make it a separate entity. I have seen, and a lot of studios do operate internally, but with a little bit of protection, the ability to go execute. But the more separation, the better. One of those reasons is we all know that personnel will change. And if you as the studio have a single champion and that champion leaves, that studio often dies. So separating the studio is helps you survive that, but then you still have to make sure that the studio itself delivers enough value and potentially even shifts from being a cost center to a profit center. And there's a few ways we can look at doing that.
Let's look at that. Yeah.
Yeah, like this is the like nitty gritty. Like here's how we add
Yeah.
value back to the corporate. Why you do this? One of the more interesting examples of a studio I've seen. I think they were 5 years old at the time when I talked to them about this. This is OSS Ventures in Paris, France. They build software for manufacturing. They had at the time 14,000 recorded and transcribed customer discovery calls, all linked to ideal customer profiles, user profiles with researcher and annotations and notes on that call, all loaded up into AI. So anytime they had an idea that they wanted to go test, they put this idea in the system, be like, hey, sanity check it. is this a real problem? Who do we need to talk to learn more? Is this really something that people would buy? Is there enough pressure around? Like, help us understand this really quickly. And I look at that and I go, I've worked in Fortune 500s. Nobody has that. Like, that's the difference in how you play the game as a studio, where your job is to find opportunities, validate them as quickly as you possibly can. And the opportunities that are meaningful, you go build quickly, versus, hey, we need to support as the corporation all of our current products and all of our current customers. That is priority one. We got to keep this company operating effectively. Building and testing the next like potential product that might move the needle a little bit
No,
is
thank you.
not a
Yeah.
priority, right? You don't sacrifice all of the business that you're doing for that little new thing. So it's the
Mhm.
right priority for the corporate to keep all that on track.
Right.
Um, but when I look at that kind of intelligence gathering, I look at that and go, ooh, let's make that available to the rest of the corporation, right? If the studio's out there for every company that it builds and every company that gets launched, while it's within the studio, they're always performing customer discovery calls, sales calls, all recorded, all transcribed, all fed into this AI intelligence engine. Now give access to corporate innovation, give access to product, give access to strategy. And now suddenly you get some really interesting, nuanced data that can come
Yeah.
back and really influence uh, innovation projects, product roadmap, product features, and corporate strategy, even M&A strategy, in ways that you could not do before. So I think there's a real powerful value add just to do that. So that's one way to like directly start feeding some some value back
Yeah.
to the corporate.
So now you're feed value in form of intelligence of data.
Mhm.
That's one. Okay.
Insight, like ground truth insight, what's really going on, what do customers really care about, what are the market trends that are happening in real time.
All right. But when sorry to stop you there for a moment. Now you can just there's so many tools that transcribe customers' conversation. This OSS example that you just shared. I don't know how long ago was that.
That was about a year ago.
About a year ago. Okay.
Yeah.
Okay. So there you had already all these different tools to record, to
So they
transcribe. Okay.
had
Okay.
started with a product called Dovetail, which provides some of this. They ended up building their own version
Ah,
because the AI capabilities were really in Dovetail much more focused to provide data for product managers, not venture building. So they needed to take it a couple of steps further to really extract the insights that they needed. And we see this with a lot of studios that they're building up those insight engines effectively based on all the customer discovery calls that they're doing, because they're doing a lot across the studio and across the portfolio.
so that was one,
Mhm.
and then you're talking about the second one. One in form of insights, and what's the other one?
So I like shifting the studio from a cost center to a profit center. And one way to do that is to don't start a studio in a corporate context focused on building for venture capital or internal M&A. The return time frame on that is long. You're talking 3, 5 years, 10 years or longer. But instead, if you shift it and say, hey, the first few companies we're going to build, as we build up our skill sets, our process, and our approach, are cash flow companies, service companies within our own industry and ecosystem. We know the space well. We're going to go start doing customer discovery in here. That's the insight we need to be, getting anyway for our industry. But the first couple of companies we build are cash flow. We're going to operate them independently, right? Maybe fully owned by the studio. We'll figure out the cap table structure, however the right way to play that one is. But as these companies become operational, become profitable, they distribute profits back up to the studio. That can cover the studio costs and even distribute back up to the corporation. And so in a relatively short time frame, the studio can become self-sufficient, which is a really powerful place to operate a studio from. Because now that removes you from the quarter to quarter, year to year strategic shifts that will happen in a corporation and gives you the ability to continue to operate.
You're self-sufficient, you're building that, you're building value, intelligence, you know, even
And
money,
if you can come
revenue.
back and, you know,
Mhm.
the first year, year two, and go, hey, we're starting to distribute money back up. Like, okay,
That that
that's
looks that looks great.
all right.
Yeah.
I mean, it might not be a
Yeah.
huge number, but it's like, okay, corporate venture's not doing that on that same time frame. Okay, like you're already showing up a little bit better. And like innovation, one of the consistent challenges in innovation is what's the ROI? Well, the ROI generally is years and years down the line. Hard to track back to innovation specifically because innovation is going to figure here's a new product feature, new product, hand it over to product, goes through lots of iterations, gets in the roadmap, gets launched. Like again, that's years to track back. And the studio can start in a relatively short time frame and start going, hey, here's what we built, here's exactly the return that's coming in. We can start showing ROI. So that's
So
a good position to be in.
and how fast until or at least have you noticed this can happen?
So I would point to the studio that my partners are GPs in, where inside of 15 months, they're looking at making those first distributions back to LPs. And this
15
is, they
months.
built three companies, 1.5 million total budget deployed, um, and money's coming back. So, that's how fast it can be. Now, everybody's going to do this a little differently. I wouldn't use that as an anchor point for a specific, like 1.5 is the right number to start. Like
Right.
that depends
Okay.
on where you are, your ecosystem, what you're trying to like. There's a lot of variables here, but that really does show how quickly you can do this. And in a corporate context, you might be able to shorten that time frame even more because the corporation could become the first customer. Should never become the only customer for one of those service businesses, but
All
the
right.
corporation is spending money with service businesses today anyway. Are any of those good solid candidates to build your own service company for that can expand out, start serving more than just the parent corporation, but other groups in the ecosystem and the industry? And now you've got a built-in customer. You
Yeah,
great
that's just
customer
right from the
discovery,
get-go.
like,
Yeah.
you can start moving really, really quickly.
Yeah.
Um, so yeah, you can make this happen on a relatively short time frame, and that does give you a little flexibility. The challenge is that's generally not going to be the core mission. It's a great way to start because it builds the intelligence engine, it builds your cash cushion, and you can start operating as a profit center.
Yeah.
But the real value that a studio is going to provide over time in for a corporation is major internal M&A plays. That's what typically we see is why a corporation is going to do it is they want to be able to build the next big thing that they can pull back in and really fully integrate into all their other products and services that they offer. That's where you need to move to as a studio. But starting there, it's a little harder to start demonstrating the value as quickly because it's just a longer lead time.
All right. So this whole thing, this whole process is to demonstrate value early, justify the existence of that entity.
Mhm.
Well,
And
then
build
the
the skill
market
sets,
detail. Yeah.
right? Building
Yeah.
a service business, you're going to learn very quickly what skill sets you really need to have in place to do the work. And often when you're looking at something that is going to be more of an internal M&A than going outside to get venture capital, very different businesses you're building, right? An internal M&A opportunity or something that would be ripe for a private equity exit, it looks a lot more like a cash flow company. You want good profitability from the beginning. You want customers to be able to effectively um, create that growth, not be dependent on outside capital infusion all the time. So, the alignment is already a little bit closer to cash flow anyway. You
Yeah.
just
To
now are
start.
probably going to layer in, like, I'm going to build a little bit bigger. My targets are going to be a little higher. I'm going to start leveraging debt as a really core strategic growth mechanism, which maybe I can even tap into some of the corporation's resources to facilitate some of those debt vehicles, right? There's a couple of plays you can make along those lines, but overall, there's a lot more similarities, I'd say, in building for an internal M&A and building cash flow versus building for venture capital.
Yeah, it is different. So when you think about those services and cash flowing businesses to start with, how should I think about, if I'm a corporate, how should I think about the type of service? Is something that's, parallel to my industry? I mean, how, what have you seen? What have you seen out there?
So I think the way I would look at thinking about this is, one, you got to understand what the strategic direction of the company is going to be. Where is the focus going? What's the next few years look like? Let's build companies that are going to support the market intelligence around that space really, really well and help facilitate growth into that space. Um, if you're not doing stuff that's aligned with the longer term corporate strategy anyway, you're probably setting yourself up for failure. So let's align with the
Okay,
corporate
yeah.
strategy.
Start with,
Let's keep alignment. Um, and one way to do this is actually select where you position the studio, so you have that natural alignment kind of show up. One of the best places we see to put a studio is actually within the corporate development group. So corporate development, they've got the buy function, right? M&A. They've
yeah,
got a partner function, which is corporate venture capital, venture clienting, and the venture studio, corporate venture studio, shows up as the build function. So it really completes the suite for corporate development. And corporate development is a great home typically because they've got the mandate and the budget. They've got the mandate to look forward and help really shape corporate strategy. They've got budget flexibility to go do what they need to do in that space, and they can help, tap into a lot of finance vehicles to accomplish that as needed. They've just got a little bit less quarter to quarter reporting, and they get to operate on a little bit longer time horizon. And that really suits the operation of a venture studio well. And corporate development is just, it seems like a very natural home that's very aligned with the mission
instead of innovation.
value creation that's possible.
So instead of innovation, you recommend this going under, I mean, under, you know, as a separate entity
Yes,
connected to corporate development then.
there's a very natural alignment because the goal of a studio is to create operating companies. It's not to
Yes.
create a product, it's not to create a new feature. It's to create value by creating valuable equity. That's very aligned with corporate
Yeah,
development,
super.
right? We're going to create strategic value and some equity value in direct investments we do through corporate venture. We're going to find something that we think has great equity value, especially even more value when we pull it in and merge it with our existing company. Hey, venture studio is very aligned with that same kind of thought process around creating value through equity. Innovation is typically looking, and even product, looking at things very differently. You're looking at it through a product lens or an improvement lens, not a we're going to build a standalone company and make this thing successful end to end, right? Innovation and product are usually going to be focused just on this product versus the entire ecosystem that has to be built and operated around it. In part because within a corporate, that those support structures already exist, and so now it's just uh, getting the support you need within the corporate context to deliver that as a product or service to customers.
Hmm. We're running out of time here. It's too interesting of a conversation. We should extend the time a little bit more, but maybe another round of
Sure.
conversation, Matt. But what I wanted to ask, just to finish this, I read an interesting paper that you published. It was talking about venture studios for regional growth,
Yes.
right? And this entire ecosystem and the different players and how
Mhm.
they play a function. So I'm from Latin America. I'm based in Buenos Aires, Argentina. Latin America, big region, Mexico and to Argentina. So when you envision what the perfect ecosystem should look like for regional growth? Thinking about the different players, thinking about the roles they should play in order to make a region growth and develop economically, talent pool. How what do you what do you envision how the perfect ecosystem will look like in your dreams, you know?
That's a tough one. So I'd say there's never going to be a perfect ecosystem. It's what you have to work with. So I'll take um, South America, Latin America as an example. And I'm not an expert, so I'm going to probably make some guesses that are wrong.
I'm giving just an example here of a region, but it could be any region in the world.
Well, I've seen some things in that region that imply how you might deploy a studio in that context, and how the ecosystem is going to shape that studio design and the right strategy. Venture capital, especially at the high end, late stage venture capital, is rather limited in that ecosystem. That means you have a narrowing of the funnel of the companies that are going to go through. So your odds of building through to IPO success through venture capital in those ecosystems are a lot lower. Now, the private equity industry, I think, is a lot more developed in that space. And so that might mean that as a studio, you look at that and go, building for venture doesn't have a good, strong path to liquidity. It's a lot higher risk. But if we build for private equity, we have a much higher chance of success. We can control for a lot more. And generally, when you're looking at a studio, the idea is like, how can I engineer success as much as I can? How can I set ourselves up and all the companies we build up for success? So that's one aspect. But in terms of building the whole ecosystem, the fun part about the studio model is you can build any kind of company. And so when I look at, say, building cash flow companies, that means I can build it in any ecosystem. I don't have to be in a major metro area that has a building that can house, 1,000 plus people if I'm going to build a unicorn, right? I can build it in a small rural area. I can build the kinds of companies that are right in that area. And now I can start building up local investors very quickly in that region. So this is something that gets really interesting from an economic development standpoint. I can now layer my studio strategy and go, hey, it's not just about building for venture capital. Like that's sexy, that's good headlines. Like we need it. We need the
The amount of
inspiration.
money that's wasted there is so much money burned
There's a
on
lot of money
well,
burned there,
yeah.
right? But we don't want to neglect the other pieces of the ecosystem. And attracting other groups in is not always the right answer. What can we build specifically? And that's where the studio model can really be deployed well. In almost every region, one of the things I'd want to see built is a strong investor base that found their success because they got investment and support from others. That means they're much more likely to invest in other entrepreneurs. And if you look at some of these cash flow studios that are creating companies that have the Be More Ventures that some of my partners are GPs in, their first portfolio company, I think in a little over 12 months, hit over $1 million in ARR. All right,
Um,
they're on track very quickly for that entrepreneur to basically be an angel investor, right?
yeah.
So if you start looking at building a couple of these kinds of studios in small regions, you're building up your angel investor base very quickly. That's important. Now layer on, hey, maybe we start building for M&A or private equity plays. Okay, that's the next level. It's a level up from just cash flow businesses. We're
Yeah.
looking to build a little bit more sophisticated, a little quicker, angle it for an exit rather than maybe just continue operations. But that's the strength of the studio model. Let's deploy it how we need, where we need, in the style that we need to really develop that ecosystem to make it the best it can be. And the answer is not always build for unicorns. In fact, generally it's not. Let's
Hmm.
build the basics. And the basics might be boring, but the basics can generate great returns. So I love them.
Really. Definitely. I honestly think, since I started learning about this venture studio world and how it operates, and through this conversation, I mean, what you just said is like create, yeah, companies, but create investors that will fund the next generation of entrepreneurs. And that, you create talent, you create opportunity, deploy capital, that capital grows, that gets reinvested, and you can really create a flywheel effect that will, grow potentially an entire region. Let's say a city, a
Yeah,
country, a region. It's phenomenal. So, and you're doing a great job here, Matt, and
thank you.
moving this movement forward. And part of it, thanks for letting me in to the community.
Absolutely. No, no. I loved our first conversation. This one's great as well, and I'm sure it's not going to be the last one.
Absolutely not. Matt, once again, thank you so much for the time, and I really appreciate everything you shared here.
Thanks for having me. It's been great, and like I said, we'll do it again.